Great to have you. So you have a lot of holdings when it comes to tech and also sports. I got to talk to you about something else, the bond market. When we're looking at those yields rising, you're laughing right now. How does it change your view on some of the equity investments you have and also some of the investments you have in private companies that are pre-IPO? We're going to show some of them, some of the companies that you've invested in the public markets. We're talking Palantir, Airbnb, Spotify, and other big names, and also SpaceX in the private market, and Klarna. How are these rising yields changing your view of those investments?
Well, most people don't know this about me. I actually come from the bond market. So I spent the first 12 years of my career at Goldman Sachs, Wachovia, and Deutsche Bank, dealing with fixed income credit and structured credit. We've been at historic highs, let's say over the last 25 years, based on where we started in the late 90s and the early 2000s. The bond market yields going back up is actually a healthy thing for the market. And the reason I say it's a very controversial statement, is because all of the money, because of the low historic yields, has been pushed into the private markets. So whenever someone says to me private market assets are overvalued, it's because they weren't getting the yield in fixed income or in the equity markets. They all went to the private markets. So you want to have a healthy fixed income market. You want long-term investors and retirees to be in safe asset classes. You don't want them chasing tech and private equity when they're 75 years old. So I'm a big fan of a moderate yielding bond market and not historic lows or historic highs.
Well, you also run a family office. So when we're talking about your investments for your family office, when we're talking about equities and bonds, just roughly, how are you seeing it? Is it 50% bonds, 50% equities? Give us the rough percentages.
Yeah, I think you see most family offices above $1 billion are probably in that 50% private, 50% public space. I'm a little extreme because I'm a venture capitalist and I'm a private market investor. I'm more 75, 80% private. I'm just getting better yields. I can buy boring businesses like plumbing and HVAC companies and get 15 to 20% cash-on-cash returns. I'd rather do that than be in money markets at 3.5% or 4%. And then I buy private equity or venture capital, I'm getting 20+% returns.
So you're actually of the mind that when you invest in a sports team, that's like investing in a bond. But you got to explain it to me because a sports team's not backed with the full faith and credit of the U.S. government, and it's certainly a much longer horizon than most bond investors, I would think.
Well, let me ask you this. Which one is safer, U.S. government bonds or the Dallas Cowboys?
I'm an Eagles fan. So you're talking to the wrong person.
The Eagles. Well, so here's the concept behind it. First of all, not all sports teams are safe or fixed income like or bond like. Right. I'm really thinking about the ones that have been around for 100 years, basketball, football, baseball. Okay. And the reason I'm comparing them to bonds is because it's a stream of cash flow. The majority of the revenue from the big three leagues are annual contracted revenue from media rights and sponsors. If 80% of your revenue is locked in from tier one creditors for 10 to 20 years, that's a stream of cash flow. And it's solely based on the creditworthiness of the media rights companies.
So you're saying our parent company, Comcast, NBC, Universal, that's a tier one supplier of capital, it sounds like. Moving on, I want to talk about some of your private investments. One of them is SpaceX. We're talking a lot about Elon Musk today. Our colleague David Faber did a wide-ranging interview. What's your view on SpaceX? I'm looking at the chart through Forge Global. We track the valuation of SpaceX through Forge Global. Total valuation is about $350 billion over the last year. According to Forge, the valuations jumped just about 65%. I think you think that's actually undervalued because you're saying right now the IPO market is kind of dead, which is depressing values in the private market. So are you saying that SpaceX should be even more highly valued?
Well, I'll tell you this way. Find me a company that's doing $14 billion in revenue, growing at a 56% CAGR. And you tell me what the valuation of that should be. So
$350 billion is not enough, is what you're saying.
I'm just saying it's fair for something that's trading at 10 times the CAGR of publicly traded companies. So a multiple of 20, it's around 29 times revenue. So the valuation is a little higher in the secondary market than you quoted. But if you're trading at 10 times the growth rate of publicly traded companies and you're doing public company revenue, 14+ billion, and you're introducing new products like Starlink, that's doubling in revenue every year, I think people are chasing after SpaceX, but SpaceX is literally a rocket itself.